I mentioned that we have a representative of different views. And I would like to welcome Leo Hertog from APG.
Leo Hertog, Senior Portfolio Manager Real Estate at APG Asset Management. APG manages roughly 540 billion of assets globally on behalf of Dutch pension fund clients. The real estate team in Hong Kong, New York, and Amsterdam manages roughly 43 billion of equity globally. I am responsible for new and existing investments in student housing across Europe on the private side, so not on the listed side. Besides student housing, I also manage retail as well as residential investments across Europe in markets like Iberia and Dublin, amongst others. Following our investment in US student housing, as well as our investment in Unite, the PLC, we started looking at student housing investments back in 2013, so almost 7 years ago. At that moment in time, we really found it an immature sector with limited opportunities, which were sizable, as size is an important requirement on our end. We looked at many opportunities also with potential to grow. One of the existing opportunities back in the days was the existing Opal platform before the collapse. We looked at the recapitalization, but unfortunately that didn't work. So in 2014, we backed Harrison Street with the first European venture, mainly focused on Dublin as well as the UK. And 1 year later, in 2015, we supported the student hotel with their pan-European expansion plans, which we continue to support together with our partner Ammont. And today we have more than 1.2 billion of exposure globally to the student housing sector. The lion's share of that is in Europe, across Europe, I must say. So not only in the UK, but also in continental Europe, markets like Austria, Italy, Spain, Portugal, and Holland as well. We expect to grow that exposure over the coming years, given our existing commitments we have to existing platforms. But at the same time, there's capital available also for new opportunities and platforms across Europe.
Thank you. And with this, let me also welcome Mark with decades of experience with this asset class of banking. So Mark, can you introduce yourself?
Thank you, Samuel. Yes, I may not be able to quite reach the heights that Leo has in some of those numbers that he mentioned, but certainly in terms of length of service and so on, I think I can probably trump it. I started my career in the mid-80s in Barclays Bank. And if we go back to the global financial crisis, it just so happened that I was asked to form a student accommodation team at Barclays. This was about February 2008. Prior to that, I'd been doing deals sort of almost side of the desk for student accommodation over the preceding possibly 8 years or so. And it just so happened, as I say, February 08, nobody had ever heard the words credit and crunch in the same sentence before then. And I formed this little team of 4 people. Obviously, as we know what happened, the way things played out, towards the end of 08 and in 09 and 2010, that little team of 4 grew to a team of 7. We lent £750 million to just student accommodation developers. We did dozens of deals, all very successfully, and Barclays was able to make money out of what was an extraordinary time for all of us. And it was at a time when nobody else was lending any money to anybody to build anything. So it was an exciting time and an extraordinary time. And of course, there are similarities between what I experienced then and what I'm experiencing now, sort of 10 years later, with COVID and so on. In the intervening period, I continued working at Barclays for until 2015. And that was all senior debt, I should say. I then moved on to a company called Titlestone, and for a while provided stretch senior debt, so a slightly different take on the capital stack. Then I was headhunted to run a company called Contour Capital, and we provided mezz finance. And for the last 2.5 years, I've now been managing director at Beaufort Capital, where we provide mezz and equity. So I've covered the whole capital stack over a good number of years now. With regard to student accommodation specifically at the present moment in time, having seen highs and lows over many years now, what can I say? it is very much a resilient sector, that we do know. At the same time, not without its challenges. I know we're going to touch on a few of those a little bit later. But I'll just say that, I mean, since I've been at Beaufort, we hadn't previously done any student accommodation transactions prior to me joining. Since that time, though, I say 2.5 years ago, we've done a few. We've got a number on our books at the moment. We've got a number in the pipeline, and we're very keen to do more. So counter-cyclical, as you said earlier, lots of positives about the sector, but not without its challenges just at this precise moment in time.
Thank you. And Arron, can you tell us more about you?
Yeah, so I head up UK and Ireland at Cheyne Capital. We have been investing in student housing since my time. I've been here 8 years now. The main changes we've seen over that time is just the different types of capital that have come into the sector over that period. So going back 8 years ago, it was incredibly narrow. Either you went on the banking side, which was very senior debt. Mark would have been one of the pioneers back then. And then you had very stretchy capital at the other end that would probably cost you 12% type money. And I think over the intervening period, what's happened is that there's been more and more capital come into the alternative debt sector, and some of that capital, or a reasonable portion, has found its way into the student market. So what you can see now is just a whole different playing field, I guess, and optionality for developers and borrowers to tailor their debt needs, I guess, to the opportunity and the equity capital that they have. So I think it's I think in times like this, that kind of playing field, I think, massively helps the sector, because in times of high volatility you're seeing at the moment, banks tend to have quite a binary view on life. They're either in or they're out, and at the moment they're probably out. They're certainly on development debt in student, from the experience that we're seeing at the moment, and therefore it's good that you have these alternative capital providers in the sector at the moment, helping new schemes come to fruition. In terms of what we do at Cheyne, we can operate across the capital. The opportunities that we look at are development debt, so we're big on development debt, so as well as mezzanine and whole loans as well. So the reason we like the sector, I guess, is it is, tends to be counter-cyclical. We're looking at, we track the numbers of students via HESA, and you can see there in years like 2009, 2010, 2011, an increased student population, and that makes sense to us. And also on top of that, we love the transparency of the sector, the fact that you can get via your good sales, real good in-depth data and analysis that support investment criteria. So there's a lot going for it. As Mark says, it's not without its challenges. Certainly in the UK, it's a very mature sector, and I guess you have to tread carefully in terms of quality of counterparty is certainly one thing that we look at very, very carefully, and depth of capital behind it. But there's definitely good opportunities in the sector, and certainly I would say that a student development opportunity was one of the first ones we did out as we came out of COVID. And the other good thing going for the sector is that, unlike some of the other big subsectors of real estate, whether it's retail, offices, hotels, there probably isn't going to be a structural change over the medium to long term. We don't see COVID having a structural change or a structural impact, albeit we do in other sectors. So I do think that there's going to be more and more institutional capital coming into the student sector, which can only bode well for some of the points you made earlier about where the yields are, etc. There's a reasonable chance that they stay firm or even come in from where they are.
And Rob, if you can ask you for introduction.
I think my opening comment was IPSX. Some of your audience won't have heard about that. There'll be 4 letters that won't mean anything. Let me just say it stands for International Property Securities Exchange. This is a stock exchange with all the benefits that that brings with it. So it is a new capital market option. There has to be scale with IPSX. So to have a single asset company, which can be multiple assets. And Samuel, I was really impressed with your presentation, just showing us just the scale and the growth. And both Mark and Arron have talked about the contracyclical nature. So what IPSX is facilitating is to allow companies holding real estate to come onto a public market. These assets can be in the European Economic Area, and it allows them to come from 50 million euro upwards. Probably the sweet spot is 100 million. And it allows it to, those companies are then sold on a public stock exchange, and shares can be taken from a euro upwards. So democratization of real estate. Because the one thing that I think everybody in the globe at the moment is looking for is opportunities to invest their money and receive a yield. There is a dearth of yield in the market. And to have the ability to invest in a company with a selection of student housing, which is actually going to give you the return better than those core asset classes, is good. To my debt colleagues on this call, there's a great opportunity to provide funding for those single asset companies. And to my equity colleague, Leo, it enables the ability to spread risk across the spectrum. So basically, speed of execution is a lot faster because basically you are looking at a prospectus, and then people can make a decision on whether or not they wish to receive the yield that you've got. And the flexibility point is really important. If you have educational establishments who basically don't want to have the binary option of selling the entire asset but wishing to retain a share, a public stock exchange allows you to do that. This call feels, and in real estate, my history is that often things aren't quite as transparent as BONARD like them to make in terms of data. Sometimes there are quiet deals done. Public stock exchanges are about transparency and the ability to have the quality of information that BONARD provides into a public market to allow that yield to be given is really very exciting as an alternative capital markets option. The one thing I would say just in closing, Samuel, before you move on to Q&A, is that in terms of where this sector has come from, in the United Kingdom at the moment, our largest listed REIT is a logistics REIT, Segro. The second biggest company is Land Securities, but the third biggest listed REIT is Unite. So student housing is definitely coming of age in terms of where it exists. Bigger than British Land, which used to historically always be our largest REIT property company. So delighted to be here, a new opportunity, very interested to join in the panel discussion, Samuel.
Thank you. And gentlemen, if I may start with the first question or area of discussion. I will start lightly. So what is attractive in student housing for capital providers, be it equity or debt? I know that Arron already touched it a little bit, so did Mark, but if you can be a little bit more specific, and I would probably start with Leo and go in the same order to address this question.
We are a long-term investor. So despite the COVID disruption, we are still a firm believer about the long-term fundamentals of the business. In short, it is there is a supply-demand imbalance. It sounds like a cliche, everybody uses it, but it's actually very rare if you compare it with other sectors. At the same time, there is a growing demand, which is also something difficult and challenging to see elsewhere. Not to mention retail, for instance. And at the same time, we see the resilience of the demand. Student enrollment is up. We've seen it in the previous crisis. People tend, and actually, people study longer, or actually study again, for instance, on a postgrad education. Last point I would like to emphasize is the higher yielding nature of the business compared to, let's say, traditional residential, or compared to, for instance, logistics nowadays. So all in all, we think the whole industry still has very strong fundamentals going forward, despite the COVID disruption we're all facing at the moment.
Thank you. And Mark, what is your take, especially when you compare it to other asset classes that you have exposure to?
Indeed, and I mean, we at Beaufort provide finance for all real estate asset classes anywhere in Great Britain, so we have got a very good lens on that. The way we see it at the moment is that there remains great opportunity here, and the reason for that is, I mean, if you just think of the very basic fundamentals, for decades, students have been living in accommodation that is not, at one level you'd say, is not fit for purpose. It's certainly not purpose-built for students. What PBSA has given us is this opportunity to give them exactly what is required, as the world moves forward. The demand and supply imbalance is very clear, but I go a step further and say that there are various areas in the country where the houses and multiple occupancy have taken hold to such a degree that various councils talk about having ghettos of students in their midst, and that's a real issue. It's an issue for the students themselves. It's an issue for the houses, what they're being used for. And during those down periods, particularly in the summer months, them becoming ghost towns where the students go home back to their parents and so on. As a consequence, lots of affordable homes could be there, and that hasn't been happening. So that's quite an issue in itself. Touching on the resilience of the sector, we're looking at a time where unemployment, as we experienced again in the global financial crisis, is going to be rife. We're told that lots of people are going to come off furlough this month and be made unemployed. Lots of students, what are they going to do? If they can't find jobs, the natural place is to go from school to university. So that's the most likely scenario as well. And we've got people who are perhaps somewhat more mature, who are in jobs, who have lost those, who will go back to university to retrain into other things. So I can still see there being an abundance of students. The other thing I'd say is that over many years now, I've been asked the question, how long do I think this sort of student bubble can last? Because, since I got involved in the late 90s, early noughties, it's been going on a fairly upward trajectory all the way through. And each time I've been asked that question, I've given the same response, which is that I can still see another 10 years of growth in it. Now, that doesn't necessarily mean 10 years of very high rents and all the rest of it. What it does say, though, is that a lot of the campuses were built, particularly in the mid-1960s. A lot of the stock that's there is crumbling, is not fit for occupation. That will need to be replaced at some stage. So there will be more accommodation built on campus. Equally, there will be more accommodation built in cities and towns and so on. And we've talked about location for many years. For me now, it's all about micro-location. It's not just good enough to know that it's in the right town or the right city, but where exactly is it? And if students are having to hurdle over the accommodation to get to their lecture theatre, here's a clue. They're going to go and live in that accommodation. They're going to roll out of bed straight into the lecture theatre, and that's what people will want. So get a good plot of land near to the front door or the back door of the university, and you can't go too far wrong. What we will probably see is a bit of cannibalisation between schemes, and the first and second generation may lose out to the third generation, but that's just the way of life.
Thank you. And Arron, what is your take here?
Just trying to find areas that the guys haven't covered yet, but very comprehensive. I think probably drilling down to the transparency for us. We love the fact that you can get really into detail here in terms of student numbers in cities, how much student accommodation purpose built, whether they're international or domestic, what the undersupply looks like. So if I compare that to other sectors, probably the only other sector that is as transparent, I guess, is hotel. Hotel sector is very transparent. You can get STR data, et cetera, and real good feasibility analysis. But student is right up there as far as we're concerned in terms of being able to really drill into numbers. So that just makes us just better at analyzing risk, and that's what it comes down to. We can't invest unless we can absolutely analyze risk. And if for as an outlier, data centers are finding incredibly difficult trying to get into the detail of where trajectory is going there. I've been trying to crack that for a number of years now, but unsuccessfully so far. So, student definitely provides us with that transparency that we need to make good investment decisions. The other part, again, there's probably two other main factors. One is the quality of developer that we deal with. We're always impressed by the amount of analysis they provide us with. Yeah, that's always just incredibly reassuring when you're underwriting risk, that you're dealing with people that absolutely fundamentally understand their sector, understand where their angle is going to be, understand where their edge is going to be, and to ensure that that their numbers come to fruition down the track. So the quality of people that we deal with, we really like in the student sector. And probably lastly, the opportunity across Europe, I think, is also incredibly exciting. If you look at the numbers in terms of penetration on purpose-built student accommodation across Europe, I mean, it's incredible when compare it to the UK. I think from the numbers I remember off the top of my head, the penetration in the UK is something like 33% purpose-built compared to student population. In places like Italy and Spain, it's low single digits in terms of penetration. So there is still great opportunity in this sector because of the lack of maturity across continental Europe.
Yeah, indeed, it's UK is in average at 25% when you look at all the cities, and Europe is at 13%. So, but Milan is 2, and Munich is 6, and so it's really undersupplied. So, thank you. Probably Rob, if you can have your take, probably from your investors. What's attractive about student housing?
I think the immediate response is yield from a new listing on a regulated market, which is what IPSX is. Anything that can actually provide a regular income stream that PBSA can provide with the level of data. And just adding to what the other guys have said, this analysis point and transparency on a public market will come to the fore. So from IPSX's point of view, for our new issuers who are IPOing on the exchange, there is a lot of credit analysis. And historically in the market, there has been quite a lot of backward credit analysis. A lot of that is out of date. What COVID has done is made the operator and the developer much more aware as to the future of those cash flows. And as far as IPSX is concerned, we're working with a party who is building on the Dun & Bradstreet failure scores to actually put a synthetic bond rating against each of the occupancies. Now, this is really exciting for real estate in general, because that credit strength is all about IPOs. Our first IPO came to the market on Thursday. This is not a concept. M7 are the issuer. They have brought forward a building of 200 million sterling in Birmingham. And the only reason why I bring this into the purpose-built PBSA market for the colleagues on the call and the recipients is the level of demand of people seeking yield would be the same here as it is in Germany, as it is in Holland, as it is people who can actually buy small amounts. So it's opening that universe of investment to the much wider market than we've ever seen before. So that's my take on it, Samuel.
what really matters for you to deploy capital, either equity or debt, in student housing? What criteria, investment strategies you need to see in this asset class? What makes it a good opportunity for you to deploy capital? So I probably start with Leo again.
A number of criteria on our end. To start with, I think the most important one is finding the right operator. Given the short-term nature of the business in terms of leases, it is really a management-intense sector. So finding the right operator to lease the building, to keep up the occupancy, to grow rents, keep OPEX low is really, really important on our end. There's a strong preference to invest in integrated platforms. If not possible, at least we take a stake in the opco, so the operator, to align the interest. In terms of alignment, another important criteria is a meaningful co-investment from our counterparty. So there's really skin in the game, and we align interest, which is really important to us. One other important criteria is size and scalability. Although we see interesting one-off and smaller projects, unfortunately, we also need to deploy money and capital on behalf of our clients annually. So we also look at a minimum size criteria, which is sort of 75 million euro equity ticket on our end. If not possible at day one, we should at least have the visibility to deploy that capital within a relatively short period because of pipeline projects, because of acquisitions, or potentially other opportunities which might pop up. And last but not least, governance. We are a financial partner, but we're not a passive partner. So we are not involved on the day-to-day operations, but ultimately we want to have a say and be part of the decision maker process of, for instance, new business plans, growth opportunities, divestments, etc., etc. So I think that is it in a nutshell on our end.
Just curious, if you opt for if the operator is so important and it is an independent opco, do you request them to participate with equity as well?
Yeah, that's the co-investment I'm referring to. So ideally, we have that within one company, an integrated company, but sometimes that's not possible or really imposes restrictions or issues. But we would like to be on both sides, and we also actually require the operator to be on both sides. So there's really skin in the game, and not, for instance, cumbersome discussions about CAPEX, who's picking up the bill and who's having the upside.
Okay. Mark, what matters to your organization?
Well, it won't surprise you, Samuel, for me to say everything that Leo's already said. So I'll take the conversation in a slightly different direction, but along the same themes. I've been very proud to be MD of Beaufort during this current crisis, when we had some decisions to make about how we would support our clients and take on new clients and so on. There were so many funders who were running to the hills, partly because they had their own issues, and in some cases because they were trying to process the likes of CBILS applications to support clients and new clients. And the reason I'm proud is the fact that we continued with the same leverage that we had previously offered. We continued with the same pricing. So we didn't reduce the leverage and we didn't increase the pricing, both of which a lot of our competitors did do. And I'm not knocking them for that, but that is the approach that the owners of Beaufort decided to take. The only thing we did change really is our strap line. To begin with, we were talking about business as usual. We thought that to say business as usual in a situation where, goodness me, people were dying of this dreadful disease was awful. So we changed that and we said funding through the cycle. And the story behind that was just basically to say, we've been here for a number of years, we're going to be here for a number of years more. We just see this as another headwind among the many headwinds that we've faced in recent times. You know, we've got Brexit looming and so on. So all of the fundamentals, all of the canons of good lending that Leo's mentioned, and then being able to look our clients in the eye and say, look, we're still here, we're still going to support you. We want good schemes in good locations, good developers, good operators. It all makes perfect sense. So that's the approach we've taken.
And Arron, as you have experience with different forms of financing, perhaps assess risk differently based on that. What makes one opportunity better than the other?
First of all, I'd say, can Leo go last next time so you can set him a bit of a challenge? But yeah, I think, look, I'm going to reiterate some of the points I made earlier, and then I'm going to take it in a slightly different angle. It's the quality of analysis and quality of the counterparty is always incredibly important to us. Yeah, it gives us confidence in who we're giving our capital to when someone presents us something where it's been well thought through, well analyzed. There's downside analysis, for example, sensitivity analysis applied. That sort of thing just helps developers and investors stay one step ahead of competition. So to the developer and investor audience out there, the analysis you provide to us is incredibly important to make a decision as to whether we're going to invest on that project compared to others. The other point I would make is around ESG as well. This is, the environmental social governance. This thing is just becoming higher and higher up the priority list, because it's gonna start feeding into risk as well. The fact is that the quality of your building, what the amount of thought that's gone into it, the quality of materials, the sustainability of materials is eventually going to differentiate you again from the crowd. And if you're not thinking about it now, I can't stress enough that is going to be an important part of criteria going forward. Certainly for us, we'll be looking at how developers think about sustainability and future proofing, how they're deriving their power for their buildings, things like volumetric construction, I think is going to be very important to this sector going forward. So these are all of the minutiae and the real angles that we look at on an investment to say, okay, this one's for us. And just to give you a real live example, we were looking at a development opportunity in London at the start of the year, and that was using volumetric construction methodology. That was 330 beds. It's being delivered this month, which is incredible. Usually on a development cycle, if you start at the beginning of 2020, you'd be delivering for the 2021-2022 academic year. This one is delivered in time for this year. So whilst maybe it doesn't, it's not saving you a huge amount on construction costs. Actually, time is money for developers. So the differentiation is going to be the amount of thought that's going into every single project in terms of the detail, the design, the amenity, the sense of arrival. Just all the little bits, I think, just make a huge difference to us making that decision.
I would probably ask you additional question and jump a little over it, and not to give Leo the benefit of being first. And so, as you are probably one of the two most experienced gentlemen here with Mark across the different forms of financing, do you see changes now over time? So you said 8 years being in this sector. Mm-hmm. So difference in between 2013, 14 and now, and before COVID, after COVID, is there more mezzanine now? Can you share a bit more on this?
Yeah, absolutely. I don't know if anyone remembers the old Savills presentation where they would detail out the changes in financing in the real estate world. But if I go back to 2015, 16, 17, it seemed like there was a 50 new debt providers coming into the market every year. That was almost a strapline. That's what it felt like. And that we definitely continue to see that. There are I get asked a lot, who are my competitors, and it changes quite regularly on who's competing against us, because there is more and more capital coming into this sector, and it will continue to mature. In my view, it will continue to mature, which is only good news for developers and investors, that you're not relying on one part of the market, whether it's the banks or the insurance market or that type of capital to fund your projects, you're just going to have more and more choice to really identify what best suits your business. And I just see that more maturing more and more. If you think about what we've gone through recently, the volatility, and in the debt world, you know, the amount of risk that's on our table at the moment in terms of high risk is not that great. Yeah, we've been able to come through this pretty, you know, I'm touching wood at the moment, pretty well unscathed at the moment. And certainly in the student sector, the investments we've seen, you know, I have to say, thinking back to how I was thinking back in March and April, it was pretty scary times in terms of occupancy, what the following year was going to look like. But I'm incredibly pleased with the way our student investments have performed of late. And that just shows that the elasticity of demand there is very strong. And look, we've seen you know, the overseas students really not come over this year, but our occupancies are incredibly strong for this year. Maybe the net income isn't as high, but considering where other asset classes have performed, student is right up there with ones that we're delighted with. So going back to the original question, because I haven't forgotten it, I think that as the debt markets mature, there'll be more and more capital come in, and there will be more and more opportunity to tailor your debt needs to your business model.
I'll jump to Mark now. Mark, with your experience across years and territories, how would you describe that LTV and LTCs changed over times in the UK, or how do they differ in between UK as a mature market and Europe as a maturing market?
Well, Samuel, I'd say, first of all, my focus has been solely on Great Britain. So if I can just focus on that, and maybe somebody else can comment about Europe. But what we have seen over a number of years is the contraction of LTV, LTC in the wake of, first of all, the global financial crisis, and now, just now. At the same time, some of us, as I mentioned, we've continued with the same level. And our rationale for that is that good schemes in good locations built by good people who know what they're doing, that's the key. I will just pick up on one of Arron's points just to reinforce it, really, which is that it's great that people can build quickly. But again, what has COVID shown us? A number of sites obviously were closed down, particularly if you look in Scotland, they had to close down. In England and Wales, it was more sort of a local decision was taken by the individuals. But that has made, obviously put some schemes under a lot of pressure to be built on time. And the concept of just-in-time building, which has been a common theme that I've seen for 20 odd years now in this sector. Every now and then, though, people realise that, you know, not having the room ready when Flossie or Johnny turn up, they leave home for the first time and they're there with their parents on opening day and they move in. And, you know, there's still somebody painting the roof, which is not good enough. And what I would suggest now is that we need to be a little bit more stringent in our requirements and build in a proper buffer. I've often said to people, look, make sure you've got a target date of perhaps end June, maybe a push end of July. Don't come to me with a scheme that's due to be built end of August or, God forbid, end of September and expect me to finance it, because we need to have buffers, and particularly if there's any more lockdown on COVID. But picking up on your leverage point a bit more clearly, I mean, we'll go up to 70% of GDV, 85% loan to cost. We still want to have some hurt money in there from the sponsors, but it's not bucket loads. And again, perhaps picking up more on Leo's earlier point, we want to support good people who know what they're doing. Student accommodation, the building of it, it's not the most complex thing in the world, but it is intricate. The sequencing is difficult, and you need to have people that can see it from both sides. One, actually physically being able to build it, and that to me, because you're replicating so many trades, is really sort of military style, following and doing everything the same. And the other, of course, is what's it going to look like to the end user? There's no point in building the best scheme in the whole world, but if it's not what the students actually want. So really growing with that over time. There's been a great evolution of different types of products and just little twists on the same product. But again, from leverage perspective, we remain very supportive, and but we have seen a bit of contraction, particularly from the senior debt providers, understandably, taking a more cautious approach in the current climate.
Our experience says that basically the mature markets of UK and Western Europe are running somewhere around 70-30, and less mature markets are about 60-40, or maybe maybe less. And what is going on now after COVID is that it probably slightly changes to maybe 35-65. Leo, your experience across the markets, is this in line with your experience or your expectation?
I think it is indeed a good summary of what we see in the market, but it's fair to say in our investments we don't go up beyond, let's say, the 60-ish% of LTC. So I'm not well positioned to actually comment on what is available beyond the 60%. But I guess what we see on the senior debt, as was also mentioned, we see less activity, i.e. less banks being active. So I think that has an impact, obviously, on LTC and on pricing, and which we are also experiencing. And sometimes even 60% in some markets is not available. And on the continent, I think if you compare the situation with 5 years ago, it still remains tough in a number of markets to convince banks about student housing, since they have no experience with it, which is totally different from what we see in the UK. And I think that probably also explains why a number of parties are willing to finance more or go up to the levels which we mentioned, 85%. Also because of the transparency of the market, more mature market, alternative operators, etc., etc. So on the continent, I think it remains difficult in general to obtain financing. That was already pre-COVID for a number of markets and cities. And we've seen indeed costs going up as a number of senior lenders are not active anymore. And what we heard is that in particular, the syndication market, which they rely on, is currently not a very active market. And a number of banks still also have loans on their books, which they never contemplated holding on to their books. So they first need to solve that issue before they can actually look at new business, which I think is a normal thing. But frankly, if you compare it with other sectors, I think student is still in a good spot, and banks are still interested in terms of developments, whereas I think that is extremely difficult for other sectors, for instance, offices and retail.
I think I would just one final point. I'm not anticipating, or we're not anticipating, a huge amount of distress coming into the student sector. I think that's an important differentiator. Yeah, across other sectors, we're sort of waiting for it to happen, and some of it's already happening. And that's an extremely good fundamental. Yeah, that in points of volatility, we're not expecting to see very much, if any, distress in student housing, which ultimately is one of the reasons why we invest.
Before I go to last question, asking Rob, I would probably encourage others to post some questions. We already can see some, and Richard will take over with the questions then. So Rob, you heard other providers of capital. How does your sort of new to PBSA market alternative compare to them?
Well, it's a source of equity, basically, and it's a new source of equity. And to take Mark's Flossie and Johnny example, which is illuminating, the parents of Flossie and Johnny can actually invest in a student operator through a public market. I mean, the original question I think you posed was what was key to making a successful IPO, initial public offering, on a public stock exchange. And governance was mentioned by Leo. And clearly, if you have a public company, governance in this case, because it's a London recognised investment exchange, is to the front, regulated by the Financial Conduct Authority, just as the London Stock Exchange is. So for me, and to the LTV question you posed, IPSX runs two markets. The first market is for the retail investor, and there is a debt limit there of 40%. we wouldn't want to see companies listed on the exchange, nor would the FCA allow us to list a company with higher than 40%. But the second market is called IPSX Wholesale. This has the ability to take development opportunities and gearing if the company was so inclined, bearing in mind it has an independent board of directors responsible to the FCA, up to a gearing of 80%. But the final thing I would say, conscious of time, Samuel, is that clearly anybody who gets involved with the public market, if profile is important to them, gains huge profile because of the extent of the selling of shares in a public marketplace. And I suspect some of your listeners will be thinking about annuity income through asset management. And again, IPSX in a public market can actually provide patient and long-term capital as opposed to short-term capital.
Thank you. With this, I would like to thank you and appreciate your time and sharing experience and views on this panel. And over to you, Richard, for the Q&As, if we have some time.
Great, thanks very much, Samuel. Really interesting discussion, everybody. There's just a couple of things that I just wanted to pick up. Q&A that's been coming in. Thanks to everybody for all of those questions, and we'll try to deal with as many of those as we can just now. So Philip Rowoda, thanks for joining us, Philip. Over the past 5 years, a certain yield convergence across the jurisdictions has taken place in this asset class on the assumption that the tenant credit is global. Do you think the COVID-19 has or will slow down or even revert this trend, since operating models in the jurisdictions differ, as well as access to tenants and customers?
Well, operating companies, which is what these are, has generally been built on not great analysis. And certainly talking from the UK point of view, have a scenario where your government is now allowing you not to pay your rental. You've actually changed the dynamics and the requirement for the credit analysis. So I think what COVID has done is driven in a much, much more detailed appreciation of how credit and the occupying tenants who are going to pay your rent. But it'd be interesting to see what the debt and the institutions think.
I think from our side, look, I can't see anything but yields staying firm in this sector. If you compare, as I said earlier, if you can compare it to offices, retail, which were I guess traditional bastions of institutional capital, writing long 15, 20-year leases and park it in the drawer and collect the income, those days are gone now. Everything is operational income. If you're thinking these days that you're going to have long-term institutional type income from retail and offices, then you're going to be sadly mistaken in the future. These asset classes are going more and more operational, and therefore something like student and PRS in the future, which will be able to give you a long track record of information that says, over a 10-year period, this is what our operational and net income has looked like over that period. I think that is going to be one of the winners. And I think that COVID, all that it's done is accelerate it. For us, it will accelerate that trend.
Okay, good. Another one that came in from U Chung, thank you for this. We're speaking of equity and debt capital in the market. Is there any cross-border capital demand from Europe to fund projects directly, whether by a deal-by-deal basis or through a programmatic structure in the US, both from a debt and equity perspective? And if so, how has this demand changed between pre-COVID and post-COVID from both capital stacks? So that's interesting, just in terms of the demand for cross-border going from Europe into the US. Does anybody want to pick up that point?
I think I can answer the question, since
Excellent, Leo.
we have a New York office, and they are still very interested in new student housing deals. So there is definitely money flowing from, let's say, the Dutch environment into the US, also in student housing. So that interest remains despite COVID. Again, we are long-term investors. So if we see an interesting opportunity, there is still capital out there to finance that.
just a last one from Burkhard Hoffman. Thanks, Burkhard, for this. How do you see the financial options in Italy? So I don't know whether anybody's got a view specifically on the Italian market from that funding perspective.
Yeah, I think from our side, we have looked at Milan. I think Samuel mentioned Milan earlier. The fundamentals there are incredibly strong. I think there's 230,000 full-time students roughly in Milan, and hardly any purpose-built. I think it's about, as you said, about 3%. So those kind of fundamentals sing to someone like us. I think people like Heinz have got a couple of purpose-built student investments in Milan. So the answer is, yeah, we will definitely look to put development debt capital into places like Italy and Spain, those markets that, again, we can get good data analysis on and actually follow experienced developers, because that's the only negative, I guess, from a London-based investor looking at somewhere like Italy, is that you don't know the local market intrinsically, which is always a little bit scary for us. So if we can follow, let's call them institutional developers that we know and trust, then that makes it easier and more interesting for us.
Thanks very much to all of the speakers. Thanks, Samuel, as well, for the presentation and the taking over the role as moderator. It's given me a nice rest, and also the ability to be able to pick up on some of the views here. Thanks very much to all of the speakers for sharing your views and insight today. And thanks very much for joining us, and look forward to seeing it the next time. Thank you.